America's national debt has now reached $39 trillion, more than 120% of GDP, a level we have not seen since World War II. And the problem is not just the size of the debt, it is the cost of carrying it. Average interest rates on government borrowing have roughly doubled since 2021, which means interest payments have exploded. The United States is now spending more than $1 trillion a year just on interest before a single dollar goes to defense, Social Security, Medicare, infrastructure, or anything else. And to make things even more urgent, nearly 1/3 of publicly held treasury debt comes due this year alone. That means the government has to refinance trillions of dollars of old debt at today's much higher rates. This is the trap. The debt is too large to pay down quickly, deficits are still running, and interest costs are eating up more of the budget every year. But this is where the new Fed chair, Kevin Warsh, could completely change the game. Warsh has just taken over the Federal Reserve, and based on what he has said publicly, he wants a major shift in how the Fed thinks about inflation, interest rates, and its massive balance sheet. This shift may not be designed to solve America's debt crisis, but it could end up becoming one of the most realistic ways the government slowly escapes it. The trade-off is that it may help Washington while hurting savers, retirees, and first-time homebuyers. At his confirmation hearing, Warsh made it clear that he does not want the Fed to focus only on traditional inflation measures like core PCE, which removes food and energy. His argument is that the Fed should focus on underlying inflation, not one-time price shocks caused by things like oil, tariffs, geopolitics, or food prices. In other words, if beef prices spike because of supply issues or oil prices rise because of a war, Warsh would not necessarily treat that as the kind of inflation the Fed should fight with higher interest rates. And this is where most people get confused. Because when your grocery bill goes up, when gas gets more expensive, when rent goes higher, it obviously feels like inflation. But Warsh is making a more specific monetary argument. He is separating price increases from sustained monetary inflation. A price increase can happen because one thing becomes scarce. True sustained inflation, in his view, happens when there is too much money in the financial system chasing too few goods and services. This idea comes heavily from Milton Friedman, who famously argued that inflation is always and everywhere a monetary phenomenon. Warsh appears to share that basic view. If oil prices go up, then shipping, fertilizer, airline tickets, plastics, and thousands of other products may become more expensive, because oil is an input into almost everything. But those increases have a traceable cause. Energy became more expensive. That is the market adjusting to scarcity. Warsh's argument is that the Fed should not treat every supply shock as proof that monetary policy is too loose. Instead, the Fed should ask whether excess money creation is causing prices to rise broadly and persistently across the economy. That distinction matters, because if the Fed misreads every supply shock as inflation, it may keep rates too high for too long. But if the Fed ignores too much real inflation by calling it temporary or one-time, it could cut too early and let inflation expectations rise again. This is why Warsh's preferred inflation framework matters so much. He has shown interest in trimmed average inflation measures, which remove the biggest outliers from the inflation basket. The Dallas Fed already tracks something similar called trimmed mean PCE. Instead of focusing on every single category, it removes extreme price movements on both ends and tries to measure the middle of the distribution. In theory, this gives a cleaner view of underlying inflation. But in practice, it can also make inflation look lower than what regular people feel in real life. If rent, food, insurance, and transportation are rising, but those increases are treated as noise or outliers, the official inflation picture may look calmer than household budgets actually feel. And that is the key risk. A trimmed mean approach could give the Fed political and intellectual cover to cut rates sooner, even if people are still experiencing higher living costs. But Warsh's bigger target may not be interest rates. It may be the Fed's balance sheet. Since the financial crisis, and especially since the pandemic, the Federal Reserve has created trillions of dollars to buy treasury bonds and mortgage-backed securities. That process is called quantitative easing. Warsh has argued that this giant balance sheet is one of the main reasons inflation stayed above target. In simple terms, he believes the Fed flooded the system with too much money, and now it needs to slowly drain that money out. That means letting bonds mature without replacing them, shrinking the balance sheet over time and reducing the amount of money sitting in the financial system. In Warsh's framework, this could allow the Fed to fight inflation through balance sheet reduction while still creating room to cut short-term interest rates. In other words, run the printing press quieter, and then maybe rates do not need to stay so high. This is where the debt crisis comes in. Warsh is not walking into the Fed saying, "My job is to solve the national debt." That is not officially the Fed's job. But the second-order effects of his policies could help the Treasury in two ways. First, the short-term fix. If the Fed cuts short-term rates, the government can refinance some of its short-term debt at lower interest costs. Over the last few years, the Treasury has relied heavily on short-term bills because they are cheaper than long-term bonds. With trillions of dollars rolling over, even a small cut in short-term rates could save the government tens of billions of dollars. That does not solve the problem, but it buys time. And when you are dealing with $39 trillion of debt, buying time is extremely valuable. The long-term fix is even more powerful, but also more controversial. If inflation runs higher than interest rates, debt becomes easier to repay in real terms. Let me give you a simple example. Imagine you borrow $100 from a friend to buy a monitor, and you promise to pay back $102 in 1 year. But during that year, inflation pushes the price of that same monitor to $120. You still pay your friend $102, just like you promised. But that $102 no longer buys what $100 bought 1 year earlier. Your friend got paid back in dollars that lost purchasing power. You, on the other hand, bought the monitor with expensive dollars and repaid the debt with cheaper dollars. Now replace you with the US government, replace your friend with Treasury bond investors, and replace $100 with $39 trillion. That is how inflation quietly reduces the real burden of debt. The government does not have to officially default. It just pays back lenders in dollars that are worth less over time. This is why a world of lower short-term rates and higher actual inflation could be so powerful for Washington. It would slowly inflate away the debt. Not overnight, not painlessly, and not without consequences. But historically, countries with large debt burdens often escape through some combination of growth, inflation, and financial repression, which basically means keeping interest rates below inflation. The government wins because the real value of its debt shrinks. Borrowers with fixed-rate debt win for the same reason. But savers lose because the money sitting in their bank accounts quietly buys less every year. So what does this mean for regular Americans? The winners would likely be people who already own scarce assets and people who already have fixed-rate debt. Existing homeowners with fixed mortgages could benefit because their monthly payment stays the same, while wages, rents, and home values may rise with inflation. In real terms, their debt becomes smaller every year. People with fixed-rate student loans or other fixed-rate debt may also benefit because they borrowed in more valuable dollars and repay in less valuable dollars. Asset owners generally do better in inflationary environments because stocks, real estate, commodities, and businesses can adjust with nominal prices over time. The losers would likely be savers, retirees, and people trying to buy assets for the first time. If short-term rates fall, banks may pay less on savings accounts and money market funds. But if true inflation stays elevated, savers could still lose purchasing power. Retirees living on fixed income may feel the squeeze even more, because their expenses rise while their safe income fails to keep up. And first-time homebuyers may get hit from both sides. You might think Fed rate cuts automatically mean lower mortgage rates, but that is not always true. Mortgage rates are tied more closely to long-term Treasury yields, especially the 10-year Treasury. And long-term yields are set by the bond market. If investors believe inflation will stay high, they will demand higher yields before lending money for 10, 20, or 30 years. So the Fed could cut short-term rates while mortgage rates stay high or even rise. That is a nightmare for young buyers, expensive homes, high mortgage rates, and asset owners getting richer while new buyers get priced out. Warsh's balance sheet plan could make that even more complicated. If the Fed stops buying long-term bonds and mortgage-backed securities, demand for those assets falls. When demand falls, yields rise. And when yields rise, mortgage rates usually rise too. So even if Warsh creates a path for lower short-term rates, his plan to shrink the Fed's balance sheet could keep pressure on long-term rates. That is why this policy mix is so important. It could help the Treasury refinance short-term debt, slowly inflate away the national debt, and make the Fed look more disciplined by reducing its balance sheet. But it could also punish savers and make homeownership even harder for people who do not already own assets. Now, none of this is guaranteed. Warsh does not control the entire Federal Reserve by himself. The Federal Open Market Committee has multiple voting members, and many of them may push back if they believe inflation is still too high. Warsh may want a regime change, but the Fed is not a dictatorship. There will be disagreement, and the bond market will have its own opinion no matter what the Fed says. If investors think inflation is being underestimated, they will demand higher yields. If they think the Fed is cutting too early, they will price that in immediately. That is why the most important signal may not be what Warsh says at a press conference. It may be what the 10-year and 30-year Treasury yields do afterward. So what should you do with this information? First, understand that cash is not always safe. Cash protects you from volatility, but it does not always protect you from inflation. If your money earns 3% while your real cost of living rises 6%, you are losing purchasing power even though your account balance is going up. Second, understand that fixed-rate productive debt can actually become an advantage in an inflationary environment, especially if that debt is attached to an asset that rises over time. Third, understand that scarce assets matter. Gold, real estate, high-quality businesses, energy assets, and inflation-protected securities all respond differently, but they are worth studying if you believe inflation will remain above interest rates. Gold tends to do well when real yields fall because it does not pay interest, but it can preserve purchasing power when paper money is being diluted. TIPS, or Treasury inflation-protected securities, may be more appropriate for risk-averse investors because their principal adjusts with CPI, helping protect purchasing power. None of this is financial advice, but it is the framework investors should be thinking about. America's debt crisis is not going away on its own. The numbers are too large, the interest costs are too high, and the political will to cut spending or raise taxes enough simply does not exist. That means one of the most realistic solutions may be the quietest one, letting inflation slowly reduce the real value of the debt while keeping interest rates below the true inflation rate. If Warsh's new framework takes hold, that process could accelerate. It may not be the official plan, and it may never be said out loud, but the effect would be the same. The government gets relief, asset owners get rewarded, savers get squeezed, and anyone who does not understand what is happening risks falling further behind. The Fed is changing, the debt problem is growing, and the people who prepare early will have a massive advantage over the people who wait until it is obvious.